My name is Michael Spur, and this is the Real Estate Forum. On this episode, we are once again blessed to have Patricia McCoy, former Treasury official. She helped set up the CFPB, the Consumer Financial Protection Bureau, the mortgage part of that, and she's currently a BC law professor. We're going to talk about her new book, Sharing Risk, and get into a lot more about what's going on with the Federal Reserve and where things might be headed. Let's get into it. Thank you again for joining us. Thank you for being here again.
Michael, thank you for that gracious introduction. And
well, you're very well deserving.
As always, it's quite a pleasure.
So let's get right into it. Sharing risk. What gave you the incentive and the idea to write this book?
I had come across statistics that tried to measure how many families in the United States actually make enough to cover just their basic bills.
Right.
In other words, how many make a living income.
What did you find? What was that?
What I found out was basically 60 million families do not have a living income. A lot of them are working families. Some of them are retirees. And we're not talking about paying for...
So that's probably 1/5?
No, it's 50% of U.S. households. So
you said 60 million.
60 million households.
Oh, 60 million households, not
Right.
the population.
Correct.
Okay, I stand corrected.
That's right. So,
wow.
So, exactly, that was my reaction as well. I said, half of Americans can't pay their just basic bills. We're not talking about streaming subscriptions or anything like that.
Right.
We're just talking about the bare necessities.
It's interesting because years ago I heard an interview on NPR about a woman who did research and wrote a book on bankruptcy, and she thought it was, people being, not responsible and careless with money and buying expensive sneakers and things like this. And it was childcare, insurance, and housing costs.
And healthcare.
And healthcare. Yeah.
Right. Exactly. And there's actually been repeated recent studies on the major reasons why people file for bankruptcy. And it's exactly as you said. It has nothing to do with fancy sneakers or big TVs.
Right.
It's all the necessities of life. And so, not only are these families just not able to get through the end of the month, but in addition, all the sort of normal goals that you want any family to be able to aspire to.
Like a vacation.
A vacation, to send their kids to college. To buy a home are out of reach.
Right.
And so in the book, I propose a number of programs to enable people to have hope that they could buy a home. That they could send their kids to college,
right?
And that they can.
They had a little cushion in retirement.
Exactly, that they can retire without worry.
Right. In your book, you talked about the cost of foreclosures and how much more it affects not only the person that loses the home, but the community.
Yes.
Say more about that.
Right. Obviously, if a homeowner defaults on their loan and is foreclosed upon, for them personally, it's going to be a financial disaster.
It's devastating.
It is. You couldn't. You put the words right in my mouth. Their credit is ruined. They may lose their home. They certainly will not be able to buy a home again for many years, if ever.
Correct.
But on top of that, we came to learn after the 2008 financial crisis.
And so many people lost their homes.
Yes,
during that time.
It was 5 to 6 million homeowners lost their homes.
Wow.
And what we learned is there also are very severe spillover effects on neighborhoods. So
And being in real estate for over 3 decades and seeing several peaks
Right.
and ups and downs, I saw this happen. And not only is that family devastated, but it affects everybody on that street because all of their home values go down too.
yes, absolutely. And the research shows that home values go down within a mile radius of the foreclosed home. So that it's not just that block.
No, exactly.
It's much more widespread than that. Another problem is often these foreclosed homes sit vacant for a while. It attracts squatters. It attracts crime.
Right.
And those
Well, there are whole neighborhoods in Detroit that the city bulldozed
yes,
because of the squatters and the crime, etc., that seeps in.
that's right.
Yeah.
So it sets off a steady decline in those neighborhoods.
Well, let me ask you this. Do you think some people are saying, the real estate market is at such a high right now, and, we hear the terms unaffordable and everything. Do you think that could happen again? Do you think we could have a lot of foreclosures in the future?
So I am somewhat optimistic that we
Okay.
will not. I don't think we're totally in the clear, but I have 2 reasons for optimism. One
Okay.
is that real estate values have risen so high that homeowners have a lot of equity these days.
It's true.
And if a homeowner gets backed into a corner and they can't make their payments, then
In other words, the homeowner wouldn't be underwater, as we say in the
correct.
industry.
And
Owe more in the mortgage than what it's actually worth.
that's right.
Correct.
That's right.
Right.
So their house probably will still be worth more than they owe in their mortgage. What that means is, at worst case, they can sell the home,
Of course.
pay off the mortgage,
Right.
and move on with their lives.
And it's not going to devastate their credit,
Correct.
and et cetera, et cetera.
Correct. Exactly.
Yeah.
A second thing is after the 2008 financial crisis,
Sure.
the Congress, along with my old agency, the Consumer Financial Protection Bureau, put in safeguards to make sure up front, when the mortgage is first granted, that the homeowner had enough money to make the monthly mortgage payments.
Right.
Now, that's not a panacea,
Sure.
but it is a substantial safeguard. And today's mortgages...
From what was happening before that.
Yes. Today's
Absolutely.
mortgages are much safer than they were before 2008. Now, the one thing I worry about
Sure.
is if we do have a spike in unemployment, there will be some homeowners who do not have a lot of equity, and probably that's because they bought their homes with low down payments and
True.
they're relatively new homeowners. They have
Right.
not had time to build up
Right.
equity and home appreciation. And those people may face a real threat of foreclosure, but the numbers would be much
They're
lower.
and just typically, people may not know this, but the real estate industry, we've been in a recession since 2022
Yes.
because within 7 months, interest rates doubled. They went from 3 point something to 7%,
Right.
which is almost unheard of. I had buyers that all of a sudden, they were qualified for an $800,000 mortgage, and in 6 months, they qualified for 630.
Right.
Okay, they were priced out of markets. So, a normal market for the country is roughly 6 million transactions.
Okay.
The industry is hovering around 4 million transactions.
Oh, really?
Yes.
Yeah.
It's substantially
Yeah.
less. Okay. And, we see Wall Street and many other markets, oh, they're doing great. And we in real estate are going, well, I don't know about that, So as you're mentioning foreclosures and the volume that we saw in the '08 crash, which was just devastating, we won't see that level, that many numbers, because there haven't been that many transactions.
Yes.
So those new homeowners that might be at risk are going to be far fewer.
Yes, that's right. And then other homeowners, because of their home appreciation,
Yes.
are basically in a much better place.
Right.
And they can easily avoid foreclosure if they get into trouble with their mortgage payments.
Right. Hopefully, the banking industry learned a lot through the '08 crash and might have some forgiveness if somebody's, all of a sudden there's a medical emergency or something and they're going to be 1 or 2 months behind. If they reach out to the lender and say, look, this is happening, can we work with this? Can I forgive, push back a month or something? I think some lenders.
Well, I have even better news for you than
Okay.
that. So,
Tell me.
as you know, almost all of these mortgages that mortgage lenders make, either banks or non-bank lenders, are sold to investors.
Sure, on secondary mortgage market.
That's right. And there are different groups of investors, but almost all of them have adopted formal programs to provide foreclosure prevention relief. And what
That's fantastic. Tell us more.
Yeah, and so what that means is if you're a distressed homeowner and your loan is owned by one of these investor groups, which is highly likely.
Okay.
If you're having trouble making your mortgage payment, first of all, I always tell people, don't hide your head in the sand.
Right.
Call your servicer immediately because they can tell you about your options under these programs.
Of course.
The options might be giving you several months without making mortgage payments so you can get back on your feet.
Yeah.
Or if you need more help than that, the options might be modifying your mortgage, lowering your interest rate a little bit, or stretching out the payments longer, which will lower your monthly payment.
Yeah.
In rare cases, actually cutting your principal. There are lots of constructive options, and they are all aimed at keeping this distressed homeowner in their home.
Exactly. Because it just burdens the system, and it's like a rock in a pond. Those waves just keep hitting.
That's exactly right. And the little secret is this. Many times the investors want to be cooperative because a foreclosure will cause them to lose more money than if...
And they're not in the property management business.
Correct. They're not, and that's very expensive.
And when it comes to any type of multifamily, lenders don't know the landlord-tenant law in Massachusetts. I can guarantee that. And I've seen lenders get into really sticky situations by saying the wrong thing to a tenant.
Yes.
Okay. So they don't want to foreclose on something.
That's right.
They really don't.
That's right. They often want to avoid foreclosure as much as the homeowner.
Right.
And so it's a win-win situation.
Yes. So if you're out there, definitely, if God forbid you're in a situation that you're in a tight spot, talk to your lender and servicer.
Right. It's nothing to be ashamed of. Life happens to people. My heart goes out to them when it does. And the servicer normally has constructive solutions to help
they want to help
you to stay in the home.
Yep. Let's move on to the Federal Reserve.
Yes.
I think a lot of our viewers think that, gee, the Federal Reserve cuts interest rates. Oh, mortgage rates and car loans and credit card interest, they all go down too. That's not really the case.
That is usually not the case.
Okay.
So as we all know, the Federal Reserve meets every 2 months or so to make interest rate policy, and they are either lowering or raising a particular rate that is called the federal funds rate. And the thing that our
Is that also the overnight rate that we hear?
That's what I was going to say.
Okay.
The thing that our viewers should know is that this is just the rate for overnight loans.
Okay.
So it is a low interest rate.
This is what the financial institutions borrow. That's the rate that they borrow.
Overnight.
Correct.
So banks will borrow money from each other overnight. They'll borrow it today, they'll repay it tomorrow morning.
I see.
And so this governs the interest rate on those overnight loans. Now, when the Fed cuts interest rates, credit card rates generally do go down.
Okay.
But home mortgage rates do not.
Okay.
And the question is why.
Why not? Yeah, sure.
The reason why is that home mortgages typically are not for overnight.
Right.
They are
30
for
years.
30 years.
Right.
They're for 30 years. And they are much riskier to lenders and the investors who buy them, because for that loan to be a successful investment, the homeowner has to make mortgage payments for the entire term of the loan,
Right.
which could be as long as 30 years.
Correct.
That's a very long time, and things
get
could
paid
go wrong.
back.
Yeah, and,
Right.
and things could go wrong over
Right.
this very long time. So mortgage loans, the interest rate on mortgage loans is pegged to a different type of loan, which is the 10-year Treasury bond.
Okay.
It goes up and down with 10-year Treasury bonds.
Right. I heard that often the 10-year Treasury is connected to mortgage rates.
That's
if you watch the 10-year bond, that gives a good indication of where mortgage interest rates are.
Absolutely, absolutely. Conversely, when the Fed lowers or raises this overnight rate, or just decides to keep it the same as it did in this last meeting,
Sure.
Mortgage rates, it's very hard to predict what they will do. Sometimes they will go down as the overnight rate goes down, but sometimes it will go up.
And we've seen that recently.
We've seen that recently.
Right.
Even though the overnight rate goes down, mortgage rates can go up. So there's...
And my feeling towards that was basically, and again, correct me if I'm wrong, the powers that be are saying, gee, the Fed lowered the interest rate because they're uncertain about the financial, the economic certainty of the conditions, and they feel that it might be a little bit weak, so they're lowering interest rates, and that's worrying about lowering the rate. They're like, oh, the economy is not as strong as they think, so interest rates ticked up. Is that?
Yes. So for mortgage loans and mortgage rates,
Sure.
Investors worry a lot about a couple of things. They worry that inflation will go up. And if they are worried about inflation, they're not going to lend unless they can charge a high enough interest rate to protect them
risk
against future inflation. So that will help push up mortgage rates. Right now, with the Iran war and with oil and gas prices soaring, that is feeding inflation fears. And the fact that we don't have a clear exit strategy out of the war
Not at all.
is making those inflation fears even worse.
It's the level of uncertainty within the world economy that we've seen recently has been really substantial. I feel for the farmers in the country with the uncertainty of tariffs.
Yes.
And those global supply chains that have shifted. When customers are established and then they change, it's much harder to get those customers back.
That's right.
And now with fertilizer, we get a lot of fertilizer from Canada, and we get a lot nitrogen-based products through the Strait of Hormuz.
Right.
And it's not like a farmer can say, that's okay, we'll plant in July. That's not going to happen.
No.
Again, that inflation, and it's a domino effect.
That's right. That's right.
So,
The other thing that mortgage investors worry about is job loss. Again, because if homeowners lose their jobs and then default on their mortgages, the profitability of those mortgages is going to spiral down. And so investors are so aware of the risk of unemployment that they will charge more for mortgage loans
right.
if they think that unemployment is going to go up. Now, right now, our job market mostly looks healthy. But in the past few months, there have just been little moments of
Yes.
doubt about the strength of the job market. The Fed is watching that extremely closely, and so are investors.
I think the term that's recently used is no fire, no hire.
Yes.
And
Yes.
so, okay, you've got a job, you're secure, but those recent college graduates are fighting an uphill battle to get their foot into the job market.
That's right.
Yeah.
That's right. We're not creating many new jobs.
Right.
That's right.
Any idea on that? Do you have any ideas why?
You know, we're just going to have to wait and see on that.
Okay. And again, I know you're not an economist, but
Right.
it's, I think for me, is AI having a part of that? AI is definitely going to affect things. I don't think it's going to be as sudden as we think. Watching different podcasts and things about AI, it's like, yes, okay, an AI can read an X-ray or, an MRI, substantially quicker and faster and more accurately than a human. But AI is not going to check the patient in, get them on the machine, see them when they leave, and then explain it to them. So the system has to catch up to the technology.
Yeah.
So logistics, things
Right.
aren't going to change in a year. I'm
Right.
sorry.
I think, we will see over time how AI makes inroads and the extent to which it does. But I think what is going on right now is employers are not eager to hire a bunch of new people only to fire them within
Of course.
6 months or a year. And so instead, they're having their current workers work longer hours.
Right. And take on more workload.
That's right.
Yes.
That's
No,
right.
and it makes
That's
perfect
right.
sense.
And that's why we get the pattern that you identify.
Right. We'll have to see. Let's move on and talk about what would you say to the powers that be, the policymakers now? What would you have them look at or potential risks moving forward?
What types of risks?
Well, with regard to financial, if you could change something in and around policy towards lending, monetary policy.
Monetary policy, I think the big problem right now is that it's very important for the maker of monetary policy, which in our country is the Federal Reserve,
Chairman.
to be independent of the White House and
Right.
of Congress. We have an all-out assault on the Federal Reserve right now, and
Yes.
It has stooped to lows that we have never seen
I can't agree more.
in the nation's history.
And what gives the U.S. the credibility and statute that it have been the independent departments like that were independent of politics.
That's right.
They had integrity and they stood on their own, and the other markets around the world knew that was stable. It will be interesting to see what happens with the chairman when he steps down. What's going to happen with that?
Right. So the Trump administration has shown that it is willing to bring spurious criminal investigations
against anybody.
Yes, against anybody, but in this case, against the chairman of the Federal Reserve, against another governor of the Federal Reserve. They have fought back, and there has been no credible evidence of any wrongdoing by either of them. But that type of intimidation potential, the designee, the nominee for the next Fed chair, who is Kevin Warsh, is quite mindful of. And he will be under tremendous pressure as a result to kowtow to the president. Now, what that means is easy money. What that means is slashing interest rates. That sounds nice. That sounds nice, but the problem is that it can really fuel hyperinflation.
Of course.
And we could.
And as you mentioned before, we saw the Fed lower interest rates a little bit, but the lending institutions didn't feel that and raised interest rates.
That's right, on mortgages.
Right.
That's exactly right.
So the Trump administration may want interest rates to be dropped by 0.5 point or more, and that's certainly not going to guarantee lower mortgage rates.
That's right.
Yeah.
That's exactly right. I was chuckling when you did the introduction because when I got my first mortgage, which was about 1989, I got
way back in the 1900s.
Yeah, yes, exactly. Exactly. I'm showing my age. And I got an adjustable rate mortgage, which I do not recommend. But I got an adjustable rate mortgage.
And I never recommend those to my clients.
And the initial rate was 8% a year, but it eventually adjusted to 11% a year.
Of course it goes up.
That's right.
Yes.
So imagine if we were back in an inflationary environment. Today our rates are at about 6.5%.
Right.
But they could go to 8, or
Easily.
they could go higher.
When I get in real estate, mortgage rates were at 11%.
Right.
It was just after the 80s.
Yes.
And in the 80s, they were almost 16+%.
Right.
Depending on your credit.
That's right. If we think that homeownership is out of reach today because it's unaffordable, imagine that.
Unbelievable.
So we need an independent Federal Reserve.
Yes, we do.
And we need independent monetary policy to push back against that political pressure, which is, it can come from the White House, but it can also come from Congress.
Right. So we really appreciate having you again at this table, and every time you're here, we continue to learn and grow. Thank you so much.
Michael, it's always so much fun batting things around with you, so thank you.
You're very welcome. And thank you for joining us. Follow us on YouTube, Facebook, and all those other social media pages.